I'm endlessly fascinated and curious about the world around us, about business, about politics, about the arts, about culture, developments, social issues, and the people. Most importantly, about the people that are shaping our future. Every night, I get the opportunity to have conversations, to dive into conversations with thought leaders, with change makers, entrepreneurs, politicians, and everyday heroes who unpack the ideas and stories that I think matter to all of us. What's the future of our economy? What's the future of our country? How do we build stronger communities? What can we learn from music, theater, sports, politics, the arts? How does policy shape our real lives? What does leadership look like, real leadership in today's environment? If it's interesting and relevant and topical and we're talking about it, you'll hear about it here at 6 o'clock on the Brian Crombie Radio Hour. I want to have real conversations, in-depth conversations. These are ideas we're sharing. This is the Brian Crombie Radio Hour. Thanks for joining me. Good evening, everyone, and welcome to the Brian Crombie Radio Hour. I've got Mark Borkowski with us tonight to talk about M&A. You know, I hear all these things that there's lots of money, there's lots of people interested in making purchases, making acquisitions, growing their businesses, but there's not a lot of deals out there. And then at the same time, I hear all these things about all these baby boomers that have built up these businesses over time, and they've got to think about succession. So why aren't there lots of businesses out there selling themselves to buy? Mark Borkowski is the president of Mercantile Mergers and Acquisitions Corp. It's a Toronto-based mid-market sell-side M&A firm. He's been around since 1987. He's done over 170 transactions. And we're going to talk today about mid-market M&A in 2026. Lots of money, too few great targets. Mark Borkowski, welcome to the show.
Thank you, Brian. Over 400 transactions. That's old data.
Over 400.
Look,
Well, you got to
yes,
change your website,
yes, since
buddy. You got to change your
1987.
website.
Yes. Well, that's old news. We should update our website. Brian, let's talk mergers and acquisitions in the mid-market. There is an incredulous amount of money looking to make acquisitions, and there is very little good mid-market companies to acquire. Lots and lots and lots of money, and not many good companies available. We talk about succession. We talk about the baby boomers. We talk about all the generations. Well, I'm dealing with people in their 80s, mid 80s, not ready to sell, not willing to give up. So there's just not a lot of good companies to acquire. And there is a lot of buyers and a lot of money chasing these opportunities.
So tell me about the different structures of deals, different deals that you're seeing. We've got add-ons where people are trying to do roll-ups. We've got founder exits that you've just been talking about. You've got carve-outs. What are sort of the deals that you're seeing, if any?
Well, we're not seeing a lot of carve-outs because there's not a lot of major companies divesting of businesses unless they're not profitable or they don't fit their criteria. We don't see many carve-outs. We do see a lot of founder sales where an owner has no succession, has been in business 30, 40 years, maybe longer, looking to exit, and he has no succession, or she or he has no succession. Those businesses are coming to market. But in many cases, these businesses have not scaled and they're not of great interest to the large groups that are looking to make an acquisition.
And the large groups, I meet lots of people. You and I have had dinner with some of them who want to do roll-ups. Is that happening in the marketplace? Are people able to buy a succession of several different businesses, successor businesses in one industry segment?
That's been taking place now for probably about the last 10 or 11 years. It started off in the dental market. It went into the veterinary market. It's currently taking place in the heating, ventilating, and air conditioning market. Virtually, it's taking place in the plumbing market. Any industry where there's a shortage of talent and there is good, solid businesses are being rolled up, mostly by institutional capital. Institutional capital are the private equity firms. There's at least 4,000 private equity firms in North America that are managing at least $500 million of capital, and they have to put that money out. And so they're searching for opportunities to do roll-ups, synergy. They create synergy. One, two, three, four
And
acquisitions
cut
in
costs,
a
I
group.
presume.
Yes.
4,000 in North America. How many in Canada?
Probably very active. I would probably say that have captive capital about 240, possibly 250 private equity firms that are managing money for the institutions, and they're all looking for viable acquisitions. They have to put the money out. They're charged with that responsibility.
And are Americans still looking in Canada, or is Canada
Absolutely.
dissipated that interest?
Absolutely. Brian, on a daily basis, we will get between 12 and 20 emails a day from private equity firms, strategic buyers, family offices. Let's not even talk about the search funders, the independent sponsors, and what we refer to as the LBO dreamers, people who
LBO
want to buy
dreamers.
a business. So we are overwhelmed with buyers and capital looking to make acquisitions. Companies today are having great difficulty in scaling up their businesses by growing organically. So they're doing M&A.
Why the term LBO dreamers?
Well, look, the LBO dreamers are groups that want to buy a company with the owner's money. And so those are the groups that think they can buy a viable business by acquiring a business, doing lots of vendor takebacks, earnouts, and very little cash up front. So we ignore those groups. I mean, there's lots of groups that want to acquire businesses, and they fall into different categories. So the LBO dreamers, are the groups that think they can buy a profitable company with an owner's money. Owners don't have to sell today and take all those vendor takebacks or earnouts. Um, I mean, today there's all cash deals taking place in M&A in the mid market.
So one of the big challenges has always been the bid ask spread, where the vendors have got this unreal expectation of what their firm is worth, and as you say, the buyers want to use their money and don't want to pay up. So is that narrowing, or is it still as large as it always is, or what?
It's still the same. Listen, at the end of the day, no matter who the buyer is, they've got to get a return on their investment. So they're going to do their analysis and say, look, we've got to get a payback within a certain period of time. So they are still at the table. They are still going to be buying at valuations that are reasonable, but not outrageous. There's no outrageous valuations except in markets where strategic buyers have a specific need to acquire a business.
Um, the whole idea of private credit is something that I've been hearing a lot more about lately. I was at the Toronto Economic Forum, and they told me that private credit was almost taking over public credit. What's your sense? What are you seeing?
I mean, look, it's just that there's a lot of money in the system. So let's start with 2019. Our association, the Private Equity and Venture Capital Association, makes this big declaration in 2019 that there's $1.1 trillion of dry powder. Well, you know what? In August of 2024, they now declare that there's $3.2 trillion of dry powder of available capital to invest, acquire, make investments of any sort. So there's just a lot of money in the pension funds, insurance funds, in the private endowments. There's a lot of money in the system, and there's not a lot of good projects. So everybody's crawling all over each other to try to do deals.
So this is interesting. So the scarcity in the number of deals, the scarcity in the number of opportunities to buy, is it because of quality that you're just mentioning that they're not good enough? And is that quality a factor of the management, the system, the margins, or is it that they're just not ready to sell because they're in their 80s, as you said, and they don't want to sell, or maybe they haven't done their due diligence on themselves. They don't have good accounting systems ready to go and audited, etc. So what's the problem? Is it the quality or is it preparation?
Some are quality, but at the end of the day, listen, after doing M&A for 37 years, we knock on a lot of doors. And it's astounding how many companies of any profitability, let's call it over $1 million today of EBITDA, earnings before interest, taxes, and amortization, call it over $2 million. Virtually every one of those companies has had somebody three, four, five, six, 10 times a year knocking on their door saying, "Are you ready to sell?" How many companies in North America of any size are available to be acquired? The vast majority, look, the vast majority of North American companies, and it's now something in the range of like 46% of all North American companies are owned by institutional capital.
That's a lot.
That's a lot of money. I mean, you paid your pension fees, you paid your insurance fees. During COVID, you kept up to date. Now, all of that money's gone into the insurance funds, into the pension funds, and into the endowments, and that capital needs to be deployed.
I was
Where
at
do they
this.
deploy it?
I
They
was at this.
deployed it into the private, they deployed it into public stock, they deployed it into real estate, which at the moment has its challenges. The greatest returns for the past 6 or 7 years has been in private equity. So they're out looking for acquisitions of privately owned mid-market companies, and most of them have been either not acquired or about to be acquired.
Mark, I was at this Toronto Economic Forum a couple of weeks ago, and it was interesting because on a panel were an individual from a big Norwegian fund, the Norwegian national fund that holds all of the money from all of their royalties off of the oil and gas. They own, she said, 1.5% of every single public company in the entire world.
Unbelievable.
Like it was
It's
incredible. But
unbelievable.
then beside her was one of the senior people at Brookfield Asset Management, and they do all of their investments, which are substantial, not as big, but substantial, in the billions, not in the trillions, like the Norwegian fund. But they do all their investments in public transactions, in private transactions.
Well, look, you follow the public markets, you're following the private markets. There's a great deal of returns to be had in private equity and private transactions. So, I mean, the money is in these mid-market, upper mid-market transactions that get great returns. That's where the money's going at the moment.
We're going to take a break for some messages and come back in just 2 minutes with Mark Borkowski, the head of Mercantile M&A. We're talking about what's going on in the mergers and acquisitions marketplace, particularly the mid-market, because I've been hearing about lots of capital available and frankly, lots of companies that need to be thinking about succession, the next stage, because of all these people in their 60s, 70s, and 80s that have built up these businesses and haven't sold, but yet they're not selling. And why? Maybe we just all dream that we're going to live to 110 and run our business until we're 100. I don't know. We're going to take a break. Be back in 2 minutes with Mark Borkowski. Stay with us, everybody.
Brian?
Welcome back, everyone, to the Brian Crombie Radio Hour. We're chatting tonight with Mark Borkowski. Mark is the president of a mid-market company called Mercantile M&A. He specializes in acquisitions of mid-market companies and helping the buyers and the sellers get together and get a transaction to work. Actually, I think you spend most of your time working with sellers and representing those sellers. Because as you said, some of these buyers are just LBO dreamers. I love that term. He has been president of Mercantile M&A since, is this right, 1987?
1987.
And you've done hundreds of deals.
Over 400, little over 400 transactions.
The good, the bad,
That's
and
a
the
small
ugly.
firm.
And he's here to tell us what's really trading, how to get sellers, and how to get your company extra ready without losing your team. And so let's talk about that a little bit. If someone's going to get the best bid possible, are there three or four things that you recommend that you see as the best traits for sellers to make sure that they get highest value?
Without question, many of these smaller mid-market companies don't have proper financial reporting. So at the end of the day, they have notice to reader or compilation financial statements. Any institutional buyer or any serious buyer is going to be very skeptical of looking at financial statements that are prepared on a compilation basis. So sometimes this process has to start 2 or 3 years in advance, where you tell a seller, look, your financial statements are skeptical at best. Let's prepare better financial statements. That's a start. So now we understand what the real financial picture is of these companies. That's a start. Number two, in many cases, there's no succession. The owner of these companies has been a one-man band. He has no succession. So any group coming in to try to acquire the business is going to be very skeptical of acquiring a business where the owner wants to leave within a year.
Even worse than succession or lack thereof. I found that a lot of these, owner managers, entrepreneurs that have become really successful are micromanagers. So that therefore, none of that senior management have ever had to make decisions. They make recommendations, but they don't have decision-making power. Not because they're not capable, but because the owner has never given them that opportunity, that latitude, because they're a micromanager.
He runs the business. He makes all the decisions. He's not delegated these responsibilities to a management team. And that's a problem.
Big
It
problem.
becomes an issue. It becomes a big issue going forward. How do we acquire this business with an owner that's leaving, that's made all the decisions? How do we replace that owner? So those companies become very difficult to acquire. So there's hundreds of those opportunities of businesses that can't be acquired without a great deal of effort and a great deal of management.
Do you have a curb appeal checklist or something like that you use to evaluate a seller if they're ready? Things like financials, IP, customer concentration, working capital discipline, stuff like that?
So we always start with a valuation of the business. No cost, no obligation. So anybody that we meet of any size that asks us to come in, we will do evaluation of the business based on all the metrics of what evaluation is based on. So we do a normalization of what we refer to as the EBITDA. We start there. Then we go through all the other metrics. Is there management? Is there proper systems? Is there proper reporting? But we start with giving an owner a metric on what the value of the business is. And in many cases, these people, there's always seen, well, not always, a big bridge, a big gap. We think it's worth X. They think it's worth 2 times X. All we can do is wish them well. Many of these companies are not going to sell because owners don't believe the value of what the market's willing to pay, even at a premium today.
They don't believe the value. They don't believe the value of their own, or they don't believe of their own company, or they don't believe the value that they're going to get. I don't understand.
Well, they're not going to get, they believe that the value is greater than what they think the value of the business is. So if
Yeah.
we say it's X,
Well, they take a look at a public market multiple and say, I'm going to get that. And you just can't get that in the private market.
well, you're not going to get a public multiple value for a private owner. So a business that's earning call it $2 million of, call it, earnings before interest, taxes, and amortization is probably worth between 4.5 to maybe 5 to 5.5 times EBITDA. Some of these groups believe it's worth 8 or 9 times, and it's not. It's just not going to happen unless it's in an industry or a niche where the market wants those businesses and they will pay for it because they need to acquire them.
I spoke to
In
a
health,
restaurant. I spoke to a restaurateur, a very nice restaurant recently, that thought he was going to get 6 to 8 times EBITDA in profitability. And a guy that specializes in M&A and restaurants, someone like you, told him he was going to get 2 to 3 times EBITDA.
Well, 2 to 3 times is probably a little bit low, but 3 times would be a starting point because you can get a return on your investment, and that's a starting point. On average, businesses that earn 300, 400, $500,000 of, let's call it profit or EBITDA profit, will trade at around 4 times EBITDA,
If there's
at
someone,
least.
if there's someone listening today that's got a business to sell, are there 2 or 3 quick fixes that you would recommend they think about before such time as they give you a call and take their business to market?
Show us financial statements that are legitimate. Show us financial statements that have been reviewed by an accountant that we can have some kind of dependability. If not, we'll work through the numbers together. But again, you're looking at buyers who are sophisticated, who have capital, who are looking to acquire. They're looking for good financial reporting. And most of these private companies have limped along by providing financial statements, tax returns that have been, not very, very strong.
And what they've done is they've loaded up often their company with other expenses, and then they try
Well,
to
we can do
down with
that.
day
We
rent.
can go, look, we can go through a normalization. I mean, look, the vast, and I mean vast majority of private company owners have loaded up their companies with personal expenses, with boats, cars, cell phones, family members on the payroll that don't work there. So we can go through all of that and normalize it and show that, in a normalization spreadsheet.
I
But we
honestly
still
think
have to substantiate that
they
to
should
show
do
that the company is that profitable.
they should do that ahead of time, like they really should, rather than have you normalize it. Because if you're going to represent that you're willing to sort of pad your expenses with CRA, people are going to be worried you're going to be doing other things that are inappropriate.
But there's not much more that you can cheat CRA outside of those expenses. So we do that process. We will go through a normalization. We'll start. Most of these companies will show very little profit. So we say, okay, you don't believe it, we don't believe it. So now let's go through a normalization of income.
Okay,
How
so
many
that's number
family
one.
members?
Good financials. That's one. What else?
Well, show us the real numbers. Show us what income you are earning that's not on the books. That will add to the value of the business.
Okay. When do you tell key staff?
We do that in a private session after we've signed a non-disclosure agreement. We sit together, we bring together family members, their accountant, anybody that wants to come into the meeting that is a qualified individual, and we go through this process. We do a normalization of income. We try to understand what the real profitability of the business is. From there, I can give them a real value, not only a real value, but I can give them a structure of a deal, more than likely in their industry, what a deal might look like.
One of the things that I think is beneficial, either by hiring someone like you or just making sure that there's one person that's running the process, is that there's a single point of contact. Because too often, financiers or investors try to sort of find different points of contact, different ways in to check information. And if you do that, you really run a risk of a bad process. So isn't that one of the benefits of having one point of contact?
Well, the one point of contact is we make sure that all the due diligence is done properly. And due diligence checklists cover a lot of information. Most owners don't have the proper reporting to provide all the information that these investors, buyers, or groups are seeking. So we drive the process to make sure that that information is available in advance before we start the process. Once you start the process and an owner can't provide information about the real cost of his inventory, or the real cost of bad debt, we go through this whole process of saying, look, we're now stumbling. So let's do all of that up front. So it's a long process.
I think your comment about customers is key too, because I think about Canada and our over reliance on the United States, and how that has really cost us from a national standpoint. If any business had 85% of its business with one customer, you'd be worried, and any
You're
buyer
not
would be worried.
saleable. You're not saleable. I mean, that is a problem. That is the biggest issue we encounter. We call it customer concentration. When a client that we're talking to has more than 15 or 20% of their revenue with one customer, that's a problem. The reason being, if that one customer goes away, I mean, any single business can withstand the loss of a 10% customer. If you lose a 20 or 25 or 30% customer,
It's a
you're in
big problem.
trouble.
And what about
You can't withstand that. I mean, let me give you a story. So my grandfather lost his business in 1966. He was proud. He was a manufacturer of heating, ventilating, and air conditioning engineered products, had 42 people working for him. He was proud of the fact that his very good friend, who was his customer, bought 48% of his revenue from him. They worked 12, 14, 16 hours a day. Well, you know what? His best friend went bankrupt. What happened to grandpa? 48% of his revenue went out the door.
bang?
Bam! Goodbye. He went bankrupt. So withstanding a 10 to 15% customer concentration is doable. If company owners have an excess of that, they're vulnerable. So those companies that are for sale or looking to sell that have that kind of customer concentration aren't very attractive to any of the buyers. So yes, there's lots of those sellers out there who have a 30, 40% exposure. The private equity community don't want have any interest. Private buyers that might have a larger concentration that can roll that in and reduce that might be potential buyers. So there is a sea of these sellers that are just lopsided.
I think that that really underlines the risk Canada has with the United States, over reliance on the United States. So I guess a couple of CFOs or finance ministers of our country should have listened to you. Are there some best structures that you've used recently that you think are the best way to bridge gaps? You talked about vendor takebacks already. What about earnouts? What about preferred shares? What about notes? What's your sense of structures that can bridge bid-ask spreads?
Well, today I'm telling you, for a very good, solid business, all cash deals are taking place. 75, 80%, all cash. Most owners want to exit within a year and they're looking for all cash. Earnouts are based on if come. If come comes in three types of varieties on earnouts. We share profit. Well, guess what? Sharing profit with a going concern, the buyer could load the company up with all kinds of other expenses, so there's no profit. Another variation is to come up with some portion of, call it gross margin. So your gross margin's at 40%. We will take a portion of the gross margin as an earnout. That doesn't work because the reporting is very difficult to manage. So if there's an earnout where we're going to take something on the if come, a royalty, a portion of revenue off the top is probably the only logical and only way that most owners will sell their business, with some portion of the value, some portion of the purchase price based on price.
We're going to take a break. We're chatting tonight with Mark Borkowski. He's the head of Mercantile M&A. We're talking about the sort of marketplace for mid-market acquisitions. He's saying that there's a huge amount of capital that's out looking for deals, and not a lot of good quality companies, even though there should be, that are putting themselves up for sale, and that people are hanging on too long. I want to change a little bit, if I could, after the break and come back and ask him about the real estate market because, I've heard lots of comments about powers of sale. I've heard lots of comments about developers and builders challenged. The condo market is in free fall. I want to ask him whether there's an opportunity in real estate as well. Stay with us, everyone. We'll be back in 2 minutes with Mark Borkowski. Stay with us. Welcome back, everyone, to the Brian Crombie Radio Hour. Radio Hour. We've got Mark Borkowski with us tonight. He is the principal founder, head of Mercantile M&A. He's been around since 1987. He's done over 400 deals, mid-market deals. We've been talking about really the opportunity for companies to sell themselves and for people to buy. And he's saying that there's tons of money out there to buy, but not a lot of good companies to buy. But Mark, I want to turn to real estate. The real estate market has got some big challenges right now. The condo market is in collapse. Single family homes are sort of stagnant. Prices are down. Rental rates are down. Lots of, people said that really what we were doing over the course of the last 5, 7, 10 years was selling the math rather than selling homes, because we were selling just, small shoe boxes that investors wanted because they thought they could flip them and then rent them out or sell them before they had to put out their final money. And that market is dead today because of interest rate increases and because of the lack of appreciation that they were expecting at one point in time. Because of all that, I understand that there's developers that are challenged, builders that are challenged, the sub-trades that are challenged. What's happening? What's the market? What's
Brian, you're in the real estate business, so you understand better than I or better than most. There is a lot of developers who are currently over-levered, who are not being supported by their banks and their investors, their backs are up against the wall. So there's been a big, without going into any kind of detail, a lot of projects that have been stalled. Large projects, housing projects, condo projects. So the banks now have kind of retreated and are sitting back. So no different than a lot of these troubled companies that are contemplating a sale because they've got some issue. The developers are in the same boat, but nobody seems to have come forward yet with any kind of big plan to acquire them. That's a big opportunity there. I mean,
why are the banks backing off and not supporting? I've been told that land loans are very difficult to get today because the banks are filled with them at prices, 50%, 100% greater than the current land prices. And those land loans were supposed to roll over because they were going to be taken out by construction loans. And those construction loans aren't being placed because people aren't initiating new condo projects. And so therefore you've got the banks that are sitting on big loans against land that may not be worth what they thought it was worth and what the developer thought it was worth. But what triggers the process to actually get these banks to sell or foreclose and sell, or for the developer to realize, I got to sell now?
look, at the end of the day, some of these properties, and there's not a lot of vacant property in, call it the GTA, that's easily available. Outside in Vaughan, Mississauga, Newmarket, Richmond Hill, these vacant properties that were valued at high valuations based on developers developing those properties, they're not developing them now. So banks are sitting on a lot of vacant land, a lot of unused property that's not going to be developed. And someone has to carry these mortgages, these costs.
So what's the process? If you were interested, what would you do? Give me some advice.
Go and buy cheap property. There's a lot of properties right now that are in receivership or near receivership for no guts, no glory. I mean, if you're a believer and you're in an area where you believe there's going to be a development and you're prepared to take the risk, go buy it. Buy out the bank position. The banks are incredibly reasonable at the moment in taking out their positions.
So
That's
tell me,
what I've seen.
Tell me how you do this. How do you buy out a bank position? Because if you're buying out a bank position, you're just the debt holder. You're not the equity holder. You don't have control of the property. So
Well, you can buy out the debt, you can buy out the equity, you can take the bank position out. I'm telling you, the banks are sitting on a lot of real estate properties that are not are vacant or not being developed.
okay, so you buy the bank debt and then what? Foreclose on the equity holder?
Absolutely.
And what's the process? Do you know the process that you have to go through for that?
Well, the process is, I mean, let's talk to the trustees in bankruptcy, the receivers, in terms of how the process works. So you can buy out these, but you've got to have a plan. You've got to have some reason to take these properties over. And again, the number of developers that are coming into the market that are willing to take the risk seems to have diminished. We don't see a lot of these people. They're all being hammered in projects that they're working on.
Why is this happening?
I'm not sure. I mean, look, there's a lot of developers, a lot of big plans, and there was cheap money that's not so cheap right now.
A lot of cheap money that
It was.
led to people buying like crazy, and thinking that the incredible market was going to go on forever. And they bought land and they bought a lot of land at high valuations, and they got banks to agree with it such that they'd lever up. And now that the market's down and the interest rates are up, it's a challenge.
You're sitting with a lot of raw property at valuations that were at X. Now it's X minus three. So the banks now are sitting on this property. They're very amenable. Anybody who's interested in buying up raw property, again, Richmond Hill, Newmarket, Mississauga, some of the properties out there that have a plan, they can go out and buy these properties, but we're still restricted with all the bureaucracy that's put out by these municipalities in terms of getting projects started.
Let me give you a sort of a personal comparison. Regular homes. The statistics on powers of sale were that there were about five a month 5 years ago. Today, there's 500 a month. It's gone from five a month to 500 a month. And powers of sale are 6 month old data because it takes 5 to 6 months to go through the power of sale process. And so the data that has gone from five a month to 500 a month is actually probably substantially more than that today. So for people that are listening, if they've seen a house they like that's got a power of sale, what's your recommendation? How do you go about doing something there?
Go buy it. I
How?
mean, if you've
How
got
do you go buy it?
if you've got equity and you want to acquire properties that are in power of sale, there are some bargains out there right now. Some real bargains. Maybe not in raw land unless you have a plan. You've got something you want to do with it and you're prepared to finance it. There's a lot of good deals out there.
The other thing that I've heard is a covered land play. And I wonder if you could describe that. What people have said to me is the big opportunity is because land may not be developable right away, find some land that's got a strip center on it or a house on it or a shopping center on it or something like that that's going to pay a little bit of income to cover your interest cost for 3 to 5 years, and then you can exploit it. And they describe it as a covered land play. Does that make any sense to you?
Makes a lot of sense. But you've got to find those deals. Most of the product that's out there is just 10 acres somewhere outside of Newmarket that's been undeveloped, that's gone through the process of being developed, and the city or the town has not approved it. And it's a long process. So you've got to have a plan to take these projects on, but they're being available at the moment, in my opinion, at bargain prices.
There's a article that you and I chatted about a Japanese M&A company that was really specializing in the succession business and had sort of an online marketplace where he was putting up all these companies. And he said that in Japan there were, thousands of them that were companies in that era that you talked about, the baby boomer that had built up a company that now was ready to sell out. And he was making a huge business out of succession. Is that an opportunity that you're exploiting, that we should exploit, that is happening in Canada today?
Listen, there's a lot of owners in their late 60s, 70s, and 80s that are ready to sell, but many have the wrong expectation in terms of value. Number two, they don't have all the proper reporting that we can acquire a business without a great deal of due diligence and understanding. So there's a gap. I mean, there without question there is an opportunity, but there's a bridge. We don't have the information, we don't have proper expectations, and so the process becomes not a 1 year, but a 2 year process or longer.
We're chatting with Mark Borkowski, the head of Mercantile M&A today. We're going to take a final break and come back with some concluding comments in just 2 minutes. Stay with us, everybody.
So, Brian, there are a lot of opportunities.
Welcome back, everyone, to the Brian Crombie Radio Hour. This has been, I think, a really important conversation with Mark Borkowski of Mercantile M&A. He's been around since 1987, running a mid-market M&A firm. He's done over 400 deals. He specializes in the mid-market. And he says that there are lots of companies that need to sell themselves, or at least get ready to sell themselves. And there's tons of money that is in private equity hands, family offices, institutional money, etc., that wants to buy these companies, but there's something wrong and it's not happening. Mark, what's got to happen?
Well, let's call a lot of these companies part of the Walking Dead.
The
They
Walking
just
Dead?
are not
Seriously?
ready for prime time. They haven't organized themselves for sale. They don't have proper reporting. They don't have the management structures in place. So any serious buyer group, family office, institutional buyer struggles to try to acquire these businesses because these businesses are not ready for prime time. They just haven't organized themselves. So it might be a 2 or 3 year process where you tell an owner, listen, you have no second in command. We don't have proper financial statements. We have notice to reader. I mean, that's a compilation of you giving your accountant simply your numbers. Nobody can trust that. So there's a gap. And the biggest issue, honestly, today is customer concentration. We see businesses where a company has had one customer for 10 or 15 years. It gives them 30 or 40% of their revenue, and they're proud. What if that customer goes away? It's not a saleable business unless there's some much, much larger player that can take that 30 or 40% and roll it into their equation and make it 5 or 10% of their revenue. That's a big issue. So one of the first questions after we do evaluation and normalization of income is tell us without naming any customers in the beginning, what percentage of your revenue comes from the following customers? And we hear 20, 30, 40, 50%. And that's a problem. That becomes an issue. It becomes an issue from these companies ever having an exit.
So, you're far more experienced and practiced in this business than I am, but I've had some peripheral exposure to it. And I think that the business has gone through a couple of cycles. I think that, there was this big LBO cycle where everyone thought that more debt was the solution. And so therefore that would sort of discipline management to be making better economic decisions, and that companies were underlevered and so therefore put more debt in place. And that was sort of a trend for a while. And then it was, all about roll-ups, and that we could roll things up and take out costs. And maybe it started by talking that there was synergy, but really what it was all really a cost reduction strategy. And frankly, I think some companies took out too much costs and took out things that were of true value in the company and harmed themselves. And because they had also put some debt on place, They had taken all the goodness out of that company, and the company ended up being a shallow, hulk of what it was previously. Then, I think we had the tech boom where everyone got excited about the internet and tech, and we overinvested in that. And now maybe we've got this, AI boom where everyone is investing venture capital money and public company money in AI, and got excited by that. During the last couple of years, we certainly had this incredible interest in condos, pre-construction condos, where maybe not institutional money, but lots of private money, family office money, real estate agents and lawyers and dentists bought 1, 2, 5, 7 pre-construction condos thinking they were going to make a lot of money and flip it. And some people did make a lot of money and flip them. Now I really think there's a huge opportunity, because I think what Mark Borkowski is talking about is really true, that there is a huge amount of really good companies that have been grown over the course of the last 20 to 40 to more years, that are owned by individuals in their 60s, 70s, and 80s that don't have succession, don't have a path forward, are probably undersized. A lot of them are probably, as Mark says, over-concentrated in a couple of customers, maybe don't have management teams that have been really given the latitude to make decisions. And so therefore, even if they're very capable, the owner president has kept all the decision making to themselves as a micromanager, because that's what worked for them. Not that they did, something terribly wrong, but they didn't think that they were ever going to die. They didn't think they were going to ever have to sell. They didn't think they were ever going to need someone else to take over. I think this is a huge opportunity. And I think that whether that be in the real estate business or in the HVAC business or in the dentist business or whatever, it's something that is a huge opportunity, because we need these small and medium-sized businesses to be a success from an economic standpoint. And I do think that some of them should merge with other companies, so that you do a roll-up and do take out some costs and do exploit more diversification, whether it's geographic or customer-based or whatnot. But there's a bunch of opposition to this, and the opposition is that people get wedded to these high values, and as Mark said, load up their companies with other expenses that they've got to realize. You got to take it out and clean up your financial statements. So I think that there's an opportunity here, but also a big challenge. And Mark Borkowski at Mercantile M&A is one of the gentlemen that I think could help you through this process, and I think that he can really create a bonanza in great takeovers, great acquisitions of some good companies that, with professional management, new vibrant capital and management involved, can make some dynamic companies that grow our economy. So Mark Borkowski, Mercantile M&A, really appreciate you joining us, sir. Thank you so much.
Thank you. No guts, no glory.
No guts, no glory. The Walking Dead, that was quite the comment. Oh, God.
Well, there's a lot of Walking Dead out there that just can't be sold. They can't be acquired because they're not ready. They haven't put all the pieces in place, and they don't know what to put in place. So they've got to be counseled, and it takes time. Might take 2-3 years to get them ready for prime time.
That's our show for tonight, everybody. Thank you for joining. I remind you I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. All my podcasts and videos go up on my website, briancrombie.com, on social media, on my YouTube channel, and on several different podcast servers as soon as the radio show gets broadcast to air. There's lots of different ways that my message I try to get out to you, so please try to access it. Thanks. Thanks for listening.
Thank you, Brian.